All right, let's unlock some investing secrets today.
Sounds good to me.
We're diving deep into a classic, the little book that still beats the market.
Oh, yeah, Joel Greenblatt.
Yep, it's basically the Bible for value investing.
Kind of a must-read for anyone who wants to really understand this stuff.
Yeah, and we're going to pull out all the best bits,
Yeah.
the really actionable stuff.
Give everybody a good toolkit to
Exactly.
spot good opportunities.
So Greenblatt starts off, kind of throws a curveball, says buying a stock isn't really about,
Right.
ticker symbols or whatever.
It's not about the letters. It's about owning part of a business.
owning a piece of a real company.
Yeah, becoming like a mini partner in that company.
Yeah.
You're entitled to a share of its future earnings.
I like that.
He uses this fun analogy about a sixth grader
Okay.
named Jason who builds this gum-selling empire,
Okay.
from his school.
Mm-hmm.
So owning a share of Jason's business, it just means you get a piece of his profits.
Simple.
Simple as that.
Yeah.
It's not about gambling on stock prices, It's about understanding the actual company.
Right. In potential to earn money.
Its potential to earn money.
Well, but how do we make sense of the stock market though?
Right.
Where prices go up and down like crazy.
It can be a wild ride.
Yeah, totally.
Well, Greenblatt introduces this character, Mr. Market.
Okay.
And Mr. Market is really just a way to embody the emotional roller coaster that the stock market can be.
Uh-huh.
He's driven by fear and greed, offering to buy or sell stocks at these wildly fluctuating prices.
Okay.
So
Well, Mr. Market's kind of like
one day,
popular.
one day he's super euphoric.
Yeah, like a gambler.
And he's offering you, a sky-high price
Yeah,
for your shares.
totally.
And then the next day he's in a total panic,
Right.
begging you to sell at a discount.
Right, yeah.
The point is, don't play Mr. Market's game. Don't get caught up in the hype or the fear.
Right.
Instead, use your understanding of the business's true worth
I like that.
to make rational decisions.
Okay, so don't try to time the market.
Right.
Buy when it's low, sell when it's high.
That's where the margin of safety comes in.
Okay, what is that?
Yeah, so instead of trying to perfectly time the market,
Right.
we're looking for a buffer.
Okay.
We want to buy businesses for significantly less than they're actually worth.
Oh.
Think of it as a built-in cushion
Okay.
to protect you against uncertainty,
Yeah.
potential errors in judgment.
Because we're going to make those.
We all make mistakes.
Yeah.
So you're basically minimizing your downside risk.
Okay. I like that. Minimizing downside risk. All right, so that's margin of safety.
Now, here's where things get really interesting.
I'm ready.
This is Greenblatt's magic formula.
The magic formula. All right, lay it on me.
So he claims it can help us identify good businesses at bargain prices.
It does sound kind of too good to be true.
It does.
Okay.
It does, but it all boils down to two key metrics.
Okay.
Return on capital and earnings yield.
Got it.
So return on capital tells us how efficiently a company generates profits. Are they taking every dollar they invest and turning it into even more money?
So they're good at making money.
They're good at making money.
Oh.
That's what we want to see.
But how do we figure that out?
The basic idea is pretty straightforward.
Okay.
We look at how much profit a company makes compared to the amount of money they've invested in their business.
Okay.
So think about Jason again.
All right.
Our gum-selling entrepreneur.
Okay.
His return on capital would be how much profit he makes from selling gum compared to the money he spent buying gum, setting up his little shop.
So like the more efficient he is, the better. Yeah.
Exactly.
Okay.
So if Jason's making a killing selling gum, but he had to spend a fortune on fancy gum displays
It's done.
and a prime location.
Yeah. Rent.
His return on capital might not be that impressive.
Right.
But if he's keeping costs low and selling tons of gum, his return on capital would be through the roof.
That's what we want.
That's what we want.
High return on capital.
So we want to see that a company is generating a healthy profit relative to the capital it has invested.
Okay, the higher the better.
The higher the ratio, the better.
All right, so that's return on capital.
Mm-hmm.
What about earnings yield?
All right, so earnings yield.
Bring us home.
This is all about finding those bargains.
Okay.
Those businesses that are priced attractively in the market.
Right.
It tells us how much profit a company is making compared to its current stock price.
Right.
So a high earnings yield means
we're getting a lot for...
We're getting a lot of bang for our buck.
Yeah, like a really good sale.
It's like finding a designer handbag. on clearance,
I like it.
great quality,
Yeah.
but at a fraction of the original price.
Okay, so high return on capital means they're good at making money.
Exactly.
High earnings yield means
We're getting a good deal.
we're getting a steal.
We're getting a steal.
They're taking advantage of Mr. Market being
Taking advantage of Mr. Market.
irrational.
Yeah,
Okay.
exactly. So we've got our two key ingredients, right?
I'm writing this down.
High return on capital,
Okay,
high earnings yield.
got it.
Now, Greenblatt actually back-tested this formula.
Oh, really? So he ran the numbers.
Yeah, he ran a simulation
Cool.
to see how it would have performed over 17 years.
Oh, wow. Okay. And
The results were impressive.
okay.
The magic formula consistently outperformed.
Really?
The market averages,
Wow.
often doubling or even tripling the returns
No way.
of the broader market.
That's amazing.
But of course, there were periods.
Yeah, I was going to say, it couldn't have all been smooth sailing.
Of course not. There were periods where it underperformed.
Okay.
But over the long haul, it
Right.
proved to be a winner.
So this is really like a long game.
Yeah, it's not a get-rich-quick scheme.
Yeah, you got to be patient.
It's about playing the long game.
Exactly.
Exactly. And that brings us to...
Mr. Market's going to go up and down,
Yes.
but we're going to be steady.
That brings us to one of the most crucial points
Okay.
that Greenblatt emphasizes throughout the book: patience.
Okay.
In fact, he tells the story about a guy
Okay.
who wrote a best-selling investing book.
Oh, wow. So he's like a...
He even launched a mutual fund
Okay.
based on his research,
Uh-huh.
but he couldn't resist
Oh, no.
tinkering
Tinkering
with
with-
his winning formula
To chase the quick butter.
to try to chase quick gains.
Oh, that's so tempting, though.
Is tempting.
So even this guy,
Even this guy.
who like wrote the book on this stuff,
Yeah.
couldn't help himself.
He struggled to stick with his own proven strategy.
Oh, that's fascinating.
Yeah, he ended up abandoning
Did he regret it?
the very approach that had brought him success.
Oof.
And he admits later that it was a mistake.
Yeah.
It just highlights how even the smartest investors can get
Right.
caught up in the short-term noise
Yeah.
and lose sight of the big picture.
So if this guy couldn't do it, what hope is there for the rest of us?
Right.
I mean,
Well, Greenblatt argues
yeah.
that sticking to a sound strategy,
Fair.
even when it's not the hottest thing at the moment,
Yeah.
is what separates the winners from the losers.
That's a good point.
It's about having the conviction to stay the course,
Right.
even when things get a little bumpy.
So how can we apply all this wisdom,
Right.
this magic formula stuff, in our own lives?
Well,
Is this just for the Wall Street guys, or
that's a great question.
can regular people use it?
And that's what we'll explore next.
Okay.
Greenblatt offers practical guidance
Right.
for both seasoned stock pickers
Okay.
and those who prefer a more hands-off approach.
So whether you're ready to get your hands dirty picking stocks,
Exactly.
or if you just want something a little simpler,
Yeah.
Greenblatt's got something for you.
He's got you covered.
Okay, well, stay tuned as we keep going on our deep dive
Right.
into the little book that still beats the market.
Sounds good.
All right. All right, welcome back to our deep dive into the little book that still beats the market.
We're on the hunt for those undervalued businesses.
We're talking magic formula, right?
Yeah, we're going to break it down a little further.
Okay, so return on capital and earnings yield. Those are the two biggies.
Those are the two key ingredients.
But what do those actually mean in plain English?
Well, let's start with return on capital.
Right.
Remember, we're looking for those companies that are really efficient at generating profits.
Right. They're taking that dollar and turning it into $2.
Turning it into even more money.
Yeah.
Like they've got this secret money-making machine.
Right. So high return on capital basically means they're rock stars.
They're good at making money, yeah.
But how do we find that out? Do we need like...
You don't need a fancy finance degree.
Okay, good.
It's a pretty simple idea.
Okay.
We're looking at how much profit a company makes
Okay.
compared to the amount of money they've invested in their business.
All right.
Think back to Jason, our gum entrepreneur.
Our 6th grade little
Yeah.
business tycoon.
His return on capital would be how much profit he makes from selling gum
Right.
compared to the money he spent buying gum and setting up his shop.
So like the more efficient he is with his money,
Yeah, exactly.
the higher his return on
The
capital.
higher the ratio, the better.
Okay, so Jason could be making a ton of money selling gum,
Right.
but if he spent a fortune on like, I don't know, a fancy website or something.
Fancy gum displays.
Yeah, his return on capital wouldn't be so hot.
Exactly. But if he's keeping costs low, selling tons of gum,
Yeah.
his return on capital would be through the roof.
Okay.
That's what we want to see.
We want that.
We want to see a company generating a healthy profit.
Yeah.
Relative to the capital that they've invested.
Okay, cool. So that's return on capital.
All right.
What about earnings yield? Remind me what that one's all about.
All right, so earnings yield.
This is where we find the deals.
It's all about finding the bargains.
Yeah, okay.
Those businesses that are priced really well in the market.
Okay.
It basically tells us how much profit a company is making.
Okay.
Compared to its current stock price.
So a high earnings yield basically means we're getting a steal.
We're getting a lot of bang for our buck.
We're getting that Black Friday special.
Like finding that designer handbag on clearance?
Yes, exactly. I love that.
Great quality at a fraction of the price.
Okay, so high return on capital means they're good at making money.
Exactly.
High earnings yield means we're getting a good deal.
We're getting a good deal.
And that means we're outsmarting Mr. Market.
We're taking advantage of Mr. Market.
When he's being a little,
when he's not thinking straight.
Emotional, yeah.
Exactly.
Okay, I like it. So we got our 2 secret ingredients.
Right.
High return on capital.
High return on capital.
High earnings yield.
High earnings yield.
And now Greenblatt goes and he backtests this formula.
Yeah, he actually ran a simulation.
Over like 17 years, right?
To see how it would have performed over 17 years.
That's a lot of data.
A lot of data.
And the results were good, right?
The results were remarkable.
Right.
The magic formula consistently outperformed the market.
Really?
Often by a large margin.
Wow, that's pretty impressive.
But, of course, there were periods.
Yeah, there's got to be some downs, right?
There were periods where it underperformed.
Okay.
Sometimes for years.
So even with the magic formula, we can't expect to get rich quick.
It's not a get-rich-quick scheme.
Got to be patient.
Patience is key.
Right, because Mr. Market's going to go up and down.
Mr. Market's going to do his thing.
But we're going to stay steady.
And that brings us to one of the most important points that Greenblatt makes.
Okay.
Patience.
Patience. We hear it all the time, but
It's crucial.
why is it so important in this case?
Well, he tells this story about this guy
Right.
who literally wrote a best-selling book about investing.
So this guy knows what he's talking about.
He even launched a mutual fund
Okay.
based on his research.
So he's a real deal investor.
Is the real deal.
Like,
But even he
couldn't resist.
couldn't resist tinkering with his winning formula.
Oh no, what did he do?
Trying to chase those quick gains.
I mean, that's so tempting.
It is so tempting.
When you see the market doing its thing.
You try to time it.
Yeah, you think you're smarter than everyone else?
And he ended up abandoning the very approach
Oh, wow.
that had brought him so much success.
So he like messed with his own formula.
He messed with his own formula.
Backfired.
And later, he admitted it was a huge mistake.
Ouch.
And I think it really shows how even the smartest investors
Yeah, no one's immune.
can get caught up in that short-term noise.
Right.
And lose sight of the big picture.
So if this guy, who literally wrote the book on investing,
Right.
couldn't do it,
Couldn't resist.
what hope is there for us mere mortals?
Right.
You know.
The Greenblatt says that sticking to a sound strategy,
Okay, so even when it's not
even when it's not the hot new thing,
the cool thing to do.
is what really separates
Okay.
the winners from the losers.
So don't chase trends. Stick to the plan.
Stick to the plan.
That's easier said than done, though, right?
It is.
It is.
Especially when you see other people maybe making quick gains.
Yeah, and you feel like you're missing out.
You feel like you're falling behind.
Okay, so how do we actually apply this
Wow.
this magic formula in our own lives?
Oh,
Is it only for,
the great question.
people who do this professionally, or can regular people use it?
That's what we'll get into next.
Okay.
Greenblatt actually offers a lot of practical guidance
Okay.
for both the seasoned stock pickers
Okay.
and for those who want a more hands-off approach.
So whether you're ready to get in there and pick stocks yourself,
Pick your hands dirty.
or if you're just kind of
Yeah.
looking for something a little simpler,
There's something for everyone.
Greenblatt's got you covered.
He's got you covered.
All right, well, stay tuned as we keep going deeper
All right.
into the little book that still beats the market. Okay, welcome back to the show.
Back for more magic formula.
We're going deep on risk this time.
Yeah. Gotta talk about risk.
It's the thing everyone worries about.
the big scary R word.
Right.
But Greenblatt, he doesn't shy away from it.
Oh, good.
In fact, he kind of challenges the way most people think about risk.
Okay, how so?
Well, a lot of people just focus on those short-term price swings.
Right, like when your portfolio drops 10% and you're like, oh no.
Yeah, you see red and you panic.
Yeah, exactly.
But Greenblatt says, That's not the real risk.
Okay, so what is the real risk then?
He wants us to think about risk as the potential for losing your money.
Permanently.
Permanently, yeah. So it's not about whether a stock goes up or down this week. It's about whether the underlying business is solid.
Okay, so it's got to be a company that can survive.
Exact.
The ups and downs.
Can it weather the storms?
Yeah, the long game.
Adapt to change.
Right.
And still make money years down the road.
So those like daily, weekly ups and downs, they're just noise.
They're just distractions. Yeah.
What we really care about is
the long-term health of business.
Yeah, picking a company that's built to last.
Like building a house on a solid foundation.
Like that.
You want it to withstand any storm.
Okay, so
yeah, we want companies with strong competitive advantages,
okay,
good management teams,
right,
and a track record of making consistent profits.
That makes sense. But even with all that, even if you do our homework,
right,
there's always a chance things could go wrong, right?
Of course. No investment is completely risk-free.
Yeah, and Greenblatt admits that even his magic formula isn't perfect.
He says straight up, it's not foolproof.
So no guarantees.
There are no guarantees in investing, that's the truth.
That's a good point.
But that's why patience is so important.
Right, because even with the magic formula,
yeah,
we might see those periods of underperformance.
You got to ride out those rough patches.
Okay, and that can be tough, especially when you see other things going up.
Yeah. You got to trust the process.
That's the process, okay.
Believe in the principles.
So,
and remember that money manager?
The guy who stuck to his guns.
Yeah, the one who had the conviction to stay the course.
Even when everyone told him he was crazy.
That's the mindset we need.
That's tough.
It is tough, but it can pay off big time.
Okay, so we've talked about risk in general.
Right.
Are there any risks that are specific to the magic formula?
Well, Greenblatt does mention a couple of things.
Okay.
One is that the formula could become a victim of its own success.
Okay. How's that?
Well, if too many people start using it,
right,
piling into the same stocks.
It's not a secret anymore.
It's like a secret fishing spot that gets overcrowded.
Right, everyone's catching all the fish.
Exactly.
Okay, so the prices get bid up.
And those bargain opportunities might disappear?
Right, so then the formula doesn't work as well anymore.
Yeah, but Greenblatt thinks that's unlikely to happen.
Why is that?
Because the formula, remember, it has those periods of underperformance?
Right, it's not a smooth ride.
So most people won't have the patience to stick with it.
So the people who can't handle the bumps,
they'll drop out.
They're going to bail.
And that'll keep it from getting too crowded.
I see. So the formula's own volatility kind of protects it?
It's a self-regulating system.
I never thought of it that way.
And Greenblatt also points out that as we get more data...
Right, because the world's changing so fast.
The formula might actually become even more effective.
Interesting. So even though there are risks,
yeah,
Greenblatt seems pretty optimistic about the future of the magic formula.
He believes in the long-term potential.
But he also says it's not for everyone, right?
Right. It's not a one-size-fits-all solution.
Okay.
It's not for those who want to get rich quick.
Right, the day traders.
Yeah. If you're chasing the hot stocks, this isn't for you.
You got to be patient.
You got to be patient.
Do your research.
Do your research.
And really, really believe in the approach.
It's about playing the long game.
Okay, so big picture, what are some key things you want our listeners to take away from all of this?
Well, I hope they've learned that value investing, it's a powerful approach.
Yeah.
And that it's all about focusing on the fundamentals.
The real businesses behind the stocks.
Not getting swayed by the hype or the fear.
Right, because Mr. Market's going to do his thing.
Mr. Market will always be there.
We got to be smarter than him.
And the other big takeaway is patience.
Patience. Can't say it enough.
It's not just a virtue. It's a crucial ingredient for success.
Absolutely. And, I hope people listening, they feel like they can approach investing with more confidence.
With more knowledge.
More knowledge. They've got the tools.
They have a tool.
To make good decisions.
To make informed decisions.
So whether they use the magic formula or not, those principles are still so valuable.
Those principles are timeless.
This deep dive has been awesome.
I've enjoyed it.
I've learned a ton.
Me too.
I really appreciate you breaking it all down for us.
My pleasure.
All right. That's all the time we have for today.
Well,
thanks for listening to our deep dive into Joel Greenblatt's The Little Book That Still Beats the Market.
Hope you enjoyed it.
And we'll see you next time.
Happy investing.